So hello there, this is Mona Barcelona and I'm here to discuss to you our financial plan in our business plan. So first, let us determine what financial plan means. Well, according to Paul McKinney, financial planning for a business is the task of determining how the organization will afford to achieve its strategic goals. Financial plan describes our current financial situation, financial goals, and when you want to achieve them, as well as strategies for achieving them. And as for the vision and mission of the organization, it was stated by the previous presenter, and to achieve those, let's see if the financial plan made by our organization will show if the business will achieve its goal, not only for the first year of operation, but also for the upcoming years or future years. So, in our financial plan, I'll discuss about profit and loss, cash flow statement, balance sheet, break-even analysis, and financial analysis. And for the first part of the financial plan is income statement or the profit and loss. It elaborates the profit or loss the business is expected to generate over a given period of time. Sasta month's sales is expected to reach by 4,265,700 pesos for the first year of operation. Then to know the gross profit of the business, less the total cost of the products, which reach at 2,891,449.68 pesos, which gives us the value of gross profit or net sales 1,374,250.32 pesos for the first year of operation. So there are also expenses needed to pay annually like insurance, vehicles, expenses, and etc. So less the total expenses a year of 311,131.49 pesos, which we have the net profit 1,063,118.83 pesos as for the first year of operation of the business. And take note, Sasta months is expected to grow at 10% for the next year, which will lead to increasing the net profit of the next years. As for the cash flow statement, this section provides details on cash position of the business and its ability to meet monetary commitments on a timely basis. It is where all the cash that received and payments of the business are listed. For the year 1, the cash incoming is the total sales where the outgoing cash were the expenses needed for operating activities, purchases of products, utilities, and such. The monthly cash balance would be the total sales of the year and less the total outgoing cash of the year, while the closing balance would be the addition of the opening balance and monthly cash balance. Since there is no cash for the opening balance of the year 1, we'll just have the same value for the monthly balance and the closing balance. And for the year 2, we now have an opening balance or the beginning balance of the year 2, which we get from the closing balance of the year 1. With the same process, but the sales and purchase of stock is expected to grow at 10% in this year and up to the next. We'll now go to balance sheet. A balance sheet is a financial statement that reports a company's asset, liabilities, and shareholders' equity at a specific point of time, and provides a basis of computing rates of return and evaluating its capital structure. It is a financial statement that provides a snapshot of a company owns and owes, as well as the amount invested by shareholders. We have the current assets, also called as the current account, is either cash or a resource that are expected to be converted into a cash within a year. These resources are often referred to as liquid assets because they are also easily converted into cash in a short period of time. As for our current assets, we have the cash or the net profit of the year 1, petty cash, which are the total amount of monthly budget or the emergency fund, a year, and the amount of equipment of our tools from the kitchen, office, and vehicles. Next is we also have the fixed asset, which may last as long as the lifespan of the business. Add the current assets and the fixed asset to get the total amount of asset. If the company has an asset, it also has the liabilities or payment on due. Sasta Munn did not take a loan for the members had fully invested for the startup cost. The only current or short-term liability or the financial obligation that are due within a year of the business is the income tax. So next is the owner's equity. It is defined as the proportion of the total value of a company's assets that can be claimed by its owners. So to calculate that, subtract the total liability to the total assets. Next is working capital, and it's the money available to meet the current short-term obligation of the business. In year 1, we subtract the total liabilities from the current assets and we get the working capital. Note that the assets and liabilities also grows at 10% for the next year. And we have here the break-even analysis, which tells how many units of product must be sold to cover the fixed and variable cost of production. It shows in the chart that the return of investments would happen in the first year of operation since the net profit in the first year reached the amount of 1,063,118.83 pesos, and it can already return the 44,809.875 pesos of each of the investments of the owners put in the startup costs, with a total of 358,479 pesos. And with that, we can say that from the vision up to the break-even analysis, it is evident that Sasta Munn is feasible and worth the time to invest. Thank you for watching.